Welcome, everyone. This is our Q&A session in the capstone course with Dan Kurzrock, who's the founder and CEO of Regrained. Dan is going to be talking with me about crowdfunding, one avenue of raising capital. But first, I would ask Dan to tell us a little bit about Regrained and its path to where it is from inception to today.
Yeah, a long and circuitous path for sure. Yeah, great to be with you, Don, as always. Hi, everybody. So my name's Dan Kurzrock. I'm the co-founder, CEO of Regrained. Regrained is probably best known for our consumer packaged products, which really we're one of the first to popularize upcycled food, which has now grown into a larger movement. Kind of behind what we're doing is we're actually an ingredient company. So we have some technology that we developed with the USDA to create think about like a flour or flours, from different manufacturer side streams that we then work with other food companies on developing new products to bring those to market. I also co-founded an industry nonprofit called the Upcycled Food Association that's working to bring together the now over 170 members worldwide that are doing upcycled food. And so it's really an environmental mission with a food product around reducing waste and feeding people and improving the way we really value our planet's resources. And so finding the right sources of capital was a really important part of how to scale this business because it's very mission driven by nature.
Terrific overview, Dan. So could you talk a little bit about, off topic, but to frame this, who your customers are, how you go to market so people understand what Regrained mission is?
Yeah, so we have a bit of a hybrid model with both, like B2B is how we scale. So selling ingredients to other companies. We also wrap it into what we call the Upcycled Food Lab. So we help companies think of the different ways that upcycling as an innovation platform can fit into their product mix. So maybe they're a snack company or maybe they're a bakery, and we help them, figure out what they can bring to market and how using upcycled ingredients, and of course, using ours. And so our main, revenue model ultimately is in the form of selling ingredients, which has a pretty long cash cycle. So that's something that we really had to think about in building this out. We do have our own manufacturing facility, which is relevant too. So we had to build out a plant. That plant houses our patented technology. It's a big machine. And that's kind of the core of what we do. We also have a consumer brand where we sell products through to retail and online, things like snack puffs or what we released most recently, kind of have different applications in and out designed to really agitate different categories for the B2B business. So it looks like a B2B kind of CPG, to use all the jargon, business to business and consumer packaged goods, like hybrid model. But really the way that we scale is through business to business.
So let's talk about how you thought about raising capital initially. Did you start with kind of the traditional friends and family? How did you decide to go with crowdfunding? And maybe you could even tell us how you got to your arms around crowdfunding and got to understand what it really consists of.
Yeah, for sure. So the business actually started as what I would describe as recreational entrepreneurship. So it was a side hustle for many years, but we were actually just putting in a little bit of personal capital to invest in things like sheet pans and basic, equipment, low amounts of packaging, and then we'd sell those, at farmers markets and things like that as a way to generate some revenue and figure out what people thought, this idea of taking something that would have otherwise gone to waste and creating, great products out of it, what we thought were great products out of it. And so that was kind of the first phase of funding, was just, putting in a few $100 and a lot of time. Then we did more traditional rewards-based crowdfunding, which people, crowdfunding that we're going to spend most of the time talking about I wish it had a different name to separate it from the legacy of like Kickstarter and Indiegogo and those sorts of things. And with that, it wasn't really raising capital in so much as collecting pre-sales, right? That's the way to think about it. So this is 2015 or so. We did a campaign where we raised about $30,000 to finance some things we were trying to do as a business. We then fulfilled those in the form of perks later on. So, on the books, it was recognized as revenue, not as a loan, not as equity. And that helped us kind of get to the next level. From there, we set up a kind of classic friends and family and angel type raise, we did, you would know the regulation name better than me, I'm forgetting it, but it was the one where you could, at the time, you could have up to 35 non-accredited investors.
Right. Reg D.
Uh,
Yes.
yeah, and so with that, and I'm sure you're going over accredited and non-accredited investors for the class, but just for the sake of conversation flow, what that enabled us to do was find people that had, ideally you find investors with the highest net worth possible because they can write the biggest checks, but it also enables you to raise a certain amount of money for people that have lower net worths, but believe in your business. In that stage in that stage, we were trying to raise something like $500,000, and I can't stress enough. I know we're not going to spend that much time talking about this in this conversation, but if you're going to friends or family or people in the community, if you're so lucky to even have access to that, I know that that's a privileged place to begin with. Remember that it's a two-way street with investors, and that it's important to know that, like, either of you can walk away from that, and it can really strain if it's done poorly, it can really strain some of those personal relationships. So everyone that we approached for investment, it was always with the framing of, hey, this doesn't make sense, no worries, and like statistically you're more likely to lose your investment than you are to get it back. Obviously we have huge amounts of confidence that we're going to make you money, or we wouldn't be dedicating our lives to doing this. But that's the risk, and I need to know that everything's going to be okay for you if not. And so there's a mutual vetting process that I think a lot of early stage founders overlook in that phase. And that's basically to get you, if you've got the kind of business where you need some capital to actually get off the ground and start building a case in order to actually have a real investable thesis for more sophisticated investors. And during that time, that's when we started to meet angel investors that weren't maybe a part of, that were several degrees away, right? So introductions, and people that introduced us to other people, and you just kind of always say yes to introductions because you never know. And we ended up raising, actually close, we were aiming for around 500. We ended up raising closer to, I believe it was like 750, something like that, from that kind of first wave.
Fantastic. How many investors in that crowd generally?
Something like 15.
That's great, Dan.
Like 15, yeah. And then we were so this is like, just to reframe where we were timeline wise, this was, I guess, 2016 and early 2017. And right around then was when some interesting things were starting to happen with what I'll refer to as equity crowdfunding. And had, after the Jobs Act passed, and basically what that did, equity crowdfunding was a thing for a long time, but only for accredited investors. And so this opened it up to non-accredited investors. And it was very much a new idea, but something that, I actually did a sustainable business school program where we looked at alternative means of finance. And so I was kind of plugged into this. And also a lot of it was happening around San Francisco, a lot of this innovation with, companies like WeFunder and whatnot, where, we're around here. I found it very interesting, this idea of democratizing venture capital and involving a broad range of stakeholders to become shareholders. And that I saw it as strategic, a way to like reach a lot of people that would want to see us be successful. I saw it as the kind of thing that, for the type of business that we were trying to build, made a lot of sense. Also from a governance perspective, at the time, the way to set it up properly was, actually makes it so that there's not voting rights, for those investors. So a lot of people worry about having too many investors and getting too many signatures and things like that, and that can be mitigated by setting it up properly. We made a lot of mistakes in that first campaign, but it was very successful. We raised about $700,000 in a Regulation CF crowdfunding raise. Actually, it was a split. We did both times we've done equity crowdfunding. We've opened up Regulation CF, which is the non-accredited investors, and Regulation D crowdfunding for accredited investors in parallel. So it's all looks like one raise. But what that enabled us to do was, if we found an investor that was interested in investing more than the maximum, which I think at the time, at least, it was around $4,000 per investor, I think maybe for the whole year, actually, for the Reg CF. And so this way, if someone had a high net worth, and they wanted to put in $10,000, whatever, that would work out. And we actually got an investor that I still to this day blows my mind. Still haven't met him. Invested $100,000 in our first campaign.
Really?
And
How do
Yeah.
you think, how do you think that person found you, heard about you? What was the means of connecting?
Yeah. So to do this well, it's important to set up a series of events, and things like that, where you're going to be exposed to a lot of people, as the campaign is live. And we actually got pushed by a strategic investor that we had to do an equity crowdfunding campaign. They had a partnership with it's actually Indiegogo and this company called Microventures, and they had a kind of set up this joint model for doing equity crowd raises. And as a part of that, one of the events that I actually got to go do was introduce Regrained while the campaign was live at a Tony Robbins event, actually, which was first time I've ever been to anything like that. And so I would say, I don't know for sure, I would say it's very likely that this person was from that audience, learned about it from that. We also did a number of various versions of pitch events and things like that while the campaign was live. And it's a really great strategy if you're going to go out and do those things anyway, is to have an actual container, for people to invest if they want to. They can see a talk and you can say, hey, we actually have this thing open. You've got to be careful on how you solicit it based on the various regulations. But you can say, hey, you can tell them that something's happening, and you get, then they can go to the URL and they can check it out. And we had people invest. One person from that camp. So we've done a second campaign, fast forwarding a little bit, and we had much of that was taken up by people reinvesting from the first campaign. And so we had some people that put in $10,000 the first time. Several of them I've built relationships with now over the years, although I haven't, met a lot of them in person, and they were people that I didn't know before we did this campaign. Went from 10,000 to 50,000, $500 to $10,000 was one. So there's an opportunity to engage these people in subsequent, campaigns. Plus all the marketing kind of community building that you can do on the side.
And so how do you communicate with the crowdfunding investors? Obviously, with any investor, you have to be an active communicator. But is there any special approach that you take here? Do you view this as an opportunity to build your brand as well as to cement your investor base?
I think, yes. And, I'll go in depth on some of that. And one thing that I realized I should probably clarify is that in parallel, actually, that we were doing I've always seen equity crowdfunding as a part of a broader capital stack. Today, it's more viable than it's ever been before to raise only on equity crowdfunding, because you can do up to 5 million, I believe, in your first raise now, which is a substantial amount for most startup businesses. At the time, the limit was $1 million. And I saw a lot of value in having a diverse group of investors, including some strategic corporates. So like if you look at the Regrained cap table, we've got, those angel investors, we've got the equity crowdfunding, and then we have some corporate strategic investors, as well. And so it's, for us, this is what I see as a key, like a core pillar of how we've capitalized the business, but it isn't the only, the only means of fundraising. And as it relates to ongoing communication with these investors, could always do a better job, for sure. We did our second raise on WeFunder, and so now we've actually been using WeFunder has a really great portal or platform, and whatever word you want to use for it, where you can actually post updates. And so as things are happening in real time, you can post updates there. Try to be in the habit of sending out quarterly-ish updates as well. Mostly with this audience, we keep it more qualitative than quantitative, in the updates. And what's key, I think, in terms of using it as a way to build the brand, is those quarterly updates. Call them brag and groan emails. And actually, Don is a friend of the business and advisor. You get a version of those too. There's always some things that are going well, some things that aren't. So the brags and the groans. But then the key part is the asks. And so we're not shy about asking this investor community for things. That could be feedback on when we did a rebrand, we basically use them as a consumer test. When we launch new products, they hear about it first. Those sorts of things. So if you think about it, many of these investors all want to make money, make return on their investment, right? They see it as an investment, but it's, these are such small investments for so many, when looked at compared to an individual's asset portfolio, that a big part of why they're doing this too is because is for the qualitative like feeling of feeling like you own something, feeling like you own a mission and a part of a company. And so we really try to tap into that and share, our successes with them and keep them engaged. And, if we have something for them to do, ask them, because most people want to help. They just need to know how.
And so you're really creating a community around the company with this group, right? That's
the goal.
very,
yeah,
and that's very different from traditional equity financing, angel investing, or private equity. That's very strategic money and can be very smart money, but there's no consumer community behind it. And so, would you consider that to be one of the principal advantages of crowdfunding?
I think so. And I think it manifests in a few ways. For example, our board today is still the founders. So we were able to, and as a mission-driven business, it's not going to be the case forever. We have no illusions, of that. But from a, I think at the early stages, having a really flexible governance structure where you can be agile and make decisions on the fly as you need to, and again, like going back to the mission, like not always prioritizing the cheapest way to do things when there might be a better way to do things for your triple bottom line mission. And so I think there's advantages in that respect too. I think as it relates to having a community around what you're doing, it's really hard to quantify the benefits of it. And I think also, this is something that I don't know if this is a video that's gonna be shared or just audio. Like I'm a white man, right? So but even it's worth mentioning that for like access to capital for founders of color and various diverse backgrounds, this is also a really powerful way to tap into an existing community to bring that to market and to create like a really to get the resources to the founders, where there's there's a real, I'm not being very articulate about it now, but there's like a very real, well-documented problem in the venture capital community around who's in the room and making the decisions and getting the capital. And it's tends to favor, I guess, people that mostly look like me. And I think equity crowdfunding also presents some really interesting advantages for founders that are don't fit that mold and are just as more deserving, just as deserving of scaling their businesses based on the merit of the business and the founder, right? So
absolutely. So levels of playing field in that sense. So what challenges have you found in kind of integrating the crowdfunding investor and the conventional investor into one cap table? Is there a tightrope that you have to walk, or has that become relatively easy over time?
It's better now. So people who've never done it before, you'll be able to do it right the first time. We had a lot of trouble with our first raise. The idea that we thought we were signing up for was that all of these investors would get rolled up into a special purpose vehicle, an SPV, right, which would be one line on the cap table. That was not set up properly. I learned later on that it wasn't even possible to do that at the time that we did the original one. And so, we have a cap table management tool where they all have a login, and it helps make that easy, but it does come at a cost. We're in the process of rolling those into I don't know if it's technically an SPV or a different type of vehicle to kind of roll them up. The second time we did it with WeFunder, who really has their act together around this and has been, I think, really at the forefront of innovation in this respect. They even did a WeFunder to fund WeFunder, which I think is kind of brilliant from a both a PR perspective and also a capital raising perspective. So the way that our second campaign worked is and the laws on this just changed a few months ago to make it even better. But like the way WeFunder did it before the law changed was they set up a custodian that invested. And so it was almost like these investors were investing in a fund or something that was then investing in Regrained. And then that custodian has a lead investor, and that's who represents the voting interests of all of it. The lead investor, was selected by us. We picked someone who was already an advisor to the business who invested in the round. And that is super clean. So that it just reads on the second round is already just one line on our cap table, and then we're working on cleaning up that first round because it just doesn't need to be that messy. Now it's from I think it's just the default, if I understand correctly, is to roll everyone into one line, at least if you're doing it through a platform that knows what they're doing.
Great. So it sounds like the benefits are clear in creating community and accessing a different kind of capital and developing kind of a brand engine to get the word out to a broader circle of potential customers through this fundraising channel. And it sounds like it's getting easier and cleaner based on the couple rounds that you've been through. But even where it sits right now, what are the burdens of pursuing this path that may give someone pause to think about it?
Yeah, for sure. One is that to set this up, it actually requires a lot of upfront diligence on the level that you would not really have to do in a seed round, maybe not even an A round, and getting this set up properly. So that can take a lot of time. It's something that the platforms should be helping entrepreneurs with, and WeFunder does. But there's the whole marketing plan for how you're going to do it. So you got to put together a whole campaign page, and it can take a lot of time, or a lot of people spend too much energy thinking about the video. Like, it's not about the video. And actually, they did a study and they found that like the video had no bearing actually on the success of the campaign, whether it was shot with an iPhone or shot in like a $20,000 studio or whatever, which I hope no one's spending that kind of money to get their video produced. But you still do have to put together a compelling offering, and it's how you're marketing the offering. And in doing that, you are required to be very transparent with your books too, as you should be, right? This is an investment that people are making, but that lives on a public domain for a period of time. So some people are uncomfortable with having that out there. I think everyone's early stage books probably look terrible, or they'd maybe be highly profitable and maybe wouldn't need to raise money, in the same way. So yeah, I would say like downsides would be if you're not comfortable being pretty transparent with just your entire business, and then a lot of people would see the time spent up front as a downside, but I actually argue that you save time across the long run. I think it's very efficient because you're reaching everything, it's leverage. So everything that you're doing is reaching a lot of people. And so if you put that time in up front, actually by the time your campaign's rolling, and obviously there's like a period of time where maybe you missed some questions, you got to add them to your FAQ, you've got people are asking you questions and you should answer them. And there's some marketing strategies for getting the word out about this, PR and whatnot. But really, if you do it well, what we found is it hits a point where it's almost the campaign's just kind of running itself. Not totally, but it's the romantic idea is like every time you refresh the page, you've got more money in it, and it gets closer to that, as it goes on. And so it's just a lot of the work is front loaded, I guess would be the way to think about it.
And so, all in, how many crowdfunding investors do you have? Does Regrand have at this point?
Yeah, that's funny. I meant to deduplicate the list before this chat to be able to answer it. I'm confident we have over 1,000. We could have as much as 1,500, but yeah, I would say it's somewhere around 1,000, 1,200, like that.
Fantastic. And do you think that certain kinds of food ventures are better suited to crowdfunding than others? Do you think having a double or triple bottom line is more likely to attract crowdfunding investors?
I do, and I think that you could wrap all of that into story, right? And then how many bottom lines you have is an aspect of how much you're really walking the walk of the story, and how you plan that. But yeah, you've got to like. Another beef jerky company is probably not going to be super successful on crowdfunding. Like, it's got to be something that's different. It's got some unique aspect of it where you can really get people bought in emotionally to the story, as well as to give them some confidence that there's some level of probability of a positive financial outcome for them. And I think mission is really a perfect way to thread the needle on that. It's people are investing in all, well, actually it's true for all early stage businesses. They're investing in in the founder, right, and the founding team, and the why. What is the business's reason for being. Now, that's not to say that if you've got the business that just has these absolutely incredible margins and you're growing at this crazy rate, and maybe that's probably enough too. If it looks like a rocket ship, people are going to like that too. But generally speaking, I do think that, and I believe the data would support it. I haven't fully analyzed it, but having talked with people that are at these different platforms, I do think campaigns that have a mission behind them tend to do better.
Right. So final question, kind of words of wisdoms, lessons learned, mistakes made that you'd advise food venture founders who are heading down this path to be thinking about with respect to crowdfunding. Is there anything that pops to mind in terms of things you might have done differently or would want to think about advising others to do differently?
Yeah, a few things. One, I know you're going to send out that article that we did with Forbes. Yes. That has detail on some of this. I think what is important to remember is that while it's come a long way, it's still pretty new, and by and large, no offense, Don, the legal community is still pretty reticent about this as a viable source of capital, and part of that is a kind of an education gap, right? Naturally, these things need to take time to be out there for enough cases to fall one way or the other to provide the fodder for a real balanced legal assessment of this. And you should listen to your legal counsel, but also you should remember that this is something that's pretty new. And I think in our case, we have a great law firm that we work with, and we brought in people from the platform's law firm too, or they have in-house legal, to be able to talk and make sure that we were doing it right, because you don't want to be paying high legal fees for your lawyers to be learning something, and maybe it's come so far enough along where that's it's much more kind of commonplace than that. The other thing I would do is don't have the illusion that this is if you build it they will come type scenario. You've really got to be confident that you can bring in through events or through your network, your community, whatever, that you can actually bring traffic to the page and convert those people into investors, because these campaigns are not going to be, and I discuss strategies in the article for doing this, the campaign's not going to be successful to net new eyeballs unless there's some social validation behind it. So you want to have a plan for raising a quarter of the money, half the money, whatever it is. It's not a hard and fast rule, as much as you can before you make this thing go public, because you're going to have a much higher conversion rate of new people if they see that this is something that hundreds of other people have already vetted and said yes and opened up their wallets for it. And so I think that's really key too.
These have been exceptional insights, Dan. I really want to thank you, and I encourage everybody again to look at the Forbes article, Forbes magazine article that's linked to our content in Moodle. And I think what you've learned from Dan today and what you'll learn from that article is really the best snapshot that you could get into this capital raising channel within the food sector. I think Dan, in many respects, is kind of at the cutting edge of doing this, and it's been extraordinarily successful. And I want to congratulate you for that, and thank you for your time today.
Yeah, no, thank you, Don. And if anyone wants to get in touch, I'm exceptionally easy to find, and so I love supporting other founders who want to try this means of fundraising out. So be in touch.
Okay, thank you very much, Dan. Be well.
Thanks. Yeah, you too.